Sebastian Vismara, Global Macroeconomist, the Bank of New York Mellon. Good morning, Sebastian.
Good morning.
What's your conclusion after the central bank announcement last week?
Well, central bank announcements last week painted a picture of higher for longer interest rates. Most of the central banks kept interest rates on hold. The ECB hiked, but the Fed didn't, the Bank of England didn't, and all have said that interest rates will remain high for longer. Obviously, that rests on the idea that the economy is going to hold up fairly well, that inflation is going to come down as they expect, but there are question marks around both of these ideas.
For the last quarter of the year?
Well, in terms of the inflation picture, we think that this inflation process is in place until at least for the next few months. However, we still think that risks to inflation are to the upside, particularly as the negative impulse that is coming from energy prices is fading away. We also think that growth is going to surprise to the downside compared to what central banks are thinking here particularly at the ECB. So the central banks will be again in a fairly difficult situation in terms of how they manage the trade-off between growth and inflation. So higher than expected inflation and lower than expected growth.
Do you think there will be a recession in Europe?
So we expect weakening in the economy in the second half of this year. I mean, we are waiting for data for the third quarter. We think that likely it will show a contraction in activity. We expect the same to happen in the last quarter of the year. However, that would be a relatively small contraction. I think eventually 2024 will be the most challenging year for the euro area as interest rates remain high for a little bit longer. We expect rates we still see upside risk to rates in the near term, but eventually as the economy slows and recession takes place towards the second half of 2024, we think rates will come down more sharply.
Where are the investment opportunities for you in this moment?
So the fact that we expect a complicated picture over the next months means that, broadly speaking, we are defensive in the near term. So we prefer sovereign fixed income to equities. And that is because really equities are pricing a world that is too optimistic in our view. We also think that there is a possibility of a soft landing, so a return to inflation to 2%, particularly in the US. However, we think that the likelihood of that scenario happening is less than what the market is pricing in. So that means that we remain more defensive in terms of our equity allocation. On the fixed income allocation, we prefer sovereign fixed income. We're not yet saying, well, it's the time to buy duration to massive amounts, but we have extended our duration profiles in light of the fact that economies are slowing. Yes, inflation might surprise a little bit to the upside. However, the risk reward still points to a favorable outlook for sovereign fixed income. It is important, however, to remain balanced between the equity and fixed income allocation. Within equities, still favoring defensive plays over cyclical plays. Quality is an area that we like quite a bit, both in terms of the long run performance potential, but also the fact that it tends to outperform the market during slowdowns. More broadly, I think to conclude, our outlook for the long run, so the strategic outlook for risky assets has become more positive. We think the generative AI, artificial intelligence story is actually a fundamental, profound shock to the global economy, not one that will play out over the next year, perhaps, but one that will affect the long-term outlook for returns. So the outlook for returns over the next 5 or 10 years. And on the back of that, on the back of higher growth over the next 5 or 10 years, we think that equities over the long run will provide pretty strong return performance.
Thank you very much, Sebastian Vismara, global economist of Bank of New York Mellon. Good day, good business.
Thank you very much. Thank you for having me.